Well, I think if we look at the landscape that we're facing that we just talked about in 2026, again, we're optimistic, cautiously optimistic on where the economy and markets will head. So as a framework, we think rates in the front end will go down ever so slightly. If it's one ease, two eases at the end of the day, again, most of the rate relief we believe is in the rearview mirror. But lower rates obviously would be a positive underlying underpinning of the economy, of the consumer, particularly of small and mid-sized businesses. So I think it's a case, and then we think volatility will be elevated because there's still a lot of uncertainties around AI, as I said earlier, inflation. There's enough to chew on here that we think volatility will be elevated. And also, very importantly, in inflation regimes north of 2.5%, let's say around that 3% range, the predictability of the stock bond correlation, one doing this and the other does that and vice versa, that becomes a lot less durable if you look at rolling periods of time. In fact, it often flips the other way, meaning they don't react the way you would hope they would. They react the opposite way. So we think diversification is a major theme for investors for 2026. And that's where alternatives come in. They provide a good degree of diversification, can enhance the opportunity for returns, and depending on what type of alts we're considering, can generate a significant yield advantage within the portfolio. So that's the framework. Our recommendation is, and not to do this tactically as a trade, right? I mean, alternatives by definition are slightly less liquid, but they have a very powerful place within a strategic asset allocation in the portfolio. So we would advise investors to continue to work a glide path to add alternatives into the portfolio. So again, stable economy, slightly lower rates in the front end. We think that's a good a combination for private credit. We would specifically be focused on middle market private credit. Why? Well, there's a little bit of a yield advantage there versus a large market private credit. However, at the middle market level, the lenders tend to have a little bit more control, a little bit better covenants, a little bit closer to the company if anything does go wrong. And we know, of course, there have been headlines, a couple of idiosyncratic, we would argue, names or two or three in the news, something to watch surely. But we think it's on the whole a decent environment. Now you talk about lower rates, and you look at, okay, well, they're typically floating rate type strategies. But again, we see very de minimis rate decreases in the front end, given the outlook, and not just our outlook. I think generally consensus that the economy is going to be pretty stable. And then therefore rating agencies, and we believe that the default expectation will be totally manageable. So sure, this year private credit 10% give or take type returns. We think, okay, rates go down a little bit in the front end, 9%. 9.5% returns. Think about that in the context of a 3% inflation environment, 6% real yield. That is quite attractive in our opinion. Do it with active and experienced managers would be clearly a recommendation. I think the other area when we think about the AI trade, the infrastructure the infrastructure bill that's going on, not only here in the US, but globally, and you think about a little bit about sticky inflation, we think real assets in alternatives would be a great place to be. But specifically, we do like industrial real estate, right? We talked about building out infrastructure. We talked about the e-commerce economy. Old warehouses are not really fit for the new economy, and there's a dearth or a shortage, actually, a significant shortage of those types of properties. That'd just be one example. And then just infrastructure at large crosses a swath of different categories, whether it's transportation, energy. Often you'll see good hedge against inflation for escalators on the income side of infrastructure assets. So again, we like those two areas in particular, private credit, real assets, and we think that'll be a great place to be not only next year, but as the durable long-term part of asset allocation and alternatives.
I think one thing, Cliff, you brought this up a couple of years ago, and this secular trend, I think, is so vital to the private markets in general. You talked about like the stock supply, just in general, You look at it, we talk about wage inflation, you talk about good inflation, you talk about service inflation. You got to think about asset inflation too. And in, 1990, I'm sorry, about 2005, we had about 6,000 companies. You go past forward 20 years later, we have less than 3,000 public companies across the board. And so we look at where that's going is it's being accessed into the private credit area. You are seeing private equity, you're seeing those areas. So to get access to those areas anymore, you need to be in the private markets in general. You can't just be in the public market anymore with that. And you brought up a perfect thing. When we talk about that longer tenor holds and so forth, you're looking at real estate, you're looking at infrastructure. These are long-term positions. Don't get cute with when you're in them and so forth, because you're looking at long-term. It's like when you buy a house. If the housing market is flat or down a bit, just buy, because in the long term, it's going to do really well. Don't worry if you're picking the bottom and so forth. So buy on the cannons, and then just hold through when you hear the flutes and the trumpets. That's the way we kind of see it in the private markets. But I think that's right on. And I think you hit on one other thing too that's really interesting. And I'm seeing this come out a lot. You're going to see a lot more of this AI, the debt coming into the private markets. And you really want to have the active managers, whether it's in the infrastructure aspect, whether it's in the industrial side of it, whether it's maybe it spills over private credit. You want those to be access to those in those areas. So I think that's why it's going to be actually forcing people to get into those areas. So the earlier, the better, and you'll see how the benefit it gives to your portfolios with the lower correlation. So just wanted to resurface that conversation that you brought up a couple of years ago, because I think that's vital to the long-term strategy.